For the last few years, inflation has been a huge problem, peaking at 9.1% in the US by July 2022, which is the highest in almost 45 years. Meaning if you'd had $10,000 in July 2020, that same $10,000 was essentially worth $8,769 just 2 years later, which we can see here from the US Purchasing Power Index. In response, the US Central Bank, the Federal Reserve, started aggressively increasing interest rates to fight this, as we can see here. Historically though, when interest rates are raised and held above average for too long, the US usually enters a recession, highlighted here. Now we'll go into detail why this is later in the video, but first we need to understand what's happening now. As a result of interest rates increasing, US inflation dropped to 2.9% in July 2024, the first time it's been under 3% since March 2021. Now this is great, but everything comes at a cost, and we are starting to see new information that could suggest the US is about to go into a recession. US unemployment has risen by 22.8% in the last 6 months. That's the biggest jump in that amount of time since COVID. Historically though, this acceleration has been one of the precursors to economic recessions. COVID, the 2008 financial crisis, the early 2000s, almost all recessions have started with rising unemployment. Now, one of the reasons for this is because as unemployment rises, less people spend money, which means businesses make less money, which means they make more people unemployed, which creates a really nasty cycle. But how do we know the unemployment isn't just going to drop back down to normal again instead of spiraling all the way up? Well, to understand this, we need to understand the market cycle, which is one of the key tools to spot the best investments and the worst investments ahead of time. Now, there are two main phases of the market. We have expansion and we have contraction. During expansion, the economy is growing. Jobs are increasing, therefore people have more money to spend. This allows businesses to expand, which leads to more jobs, which starts the cycle all over again. Now, the central bank's goal here is to keep that growth steady, ideally by keeping interest rates low. Why? Because lower interest rates just means that borrowing money, in other words, debt, is cheaper. Now, if debt is cheaper, more people and businesses will borrow, which means they'll have more money to spend than they actually have. And because there's more money circulating, this grows the economy further. But this can't go on forever. For example, in the early 2000s, the US economy was growing very fast, and lots of people were borrowing money, especially for buying homes. As more and more people were able to buy things such as houses, it became more competitive, and so house prices rose dramatically. This caused people to borrow even more to be able to afford the new prices, as we can see with the blue line here. This created what's known as a bubble. And so then in the mid-2000s, the central bank stepped in and began slowly increasing interest rates, which made borrowing money way more expensive. And so over the next few years, people had taken on so much debt in the form of mortgages that they slowly realized they couldn't afford to pay it back. And so they had to sell their homes quickly, causing the housing market to crash. Huge unemployment followed, making up the 2008 financial crisis. So this is a clear example of how we can transition from expansion to contraction. But to keep things simple, central banks raise rates to reduce overborrowing, because overborrowing can lead to inflation, bubbles, and overspending. However, increased rates eventually lead to less spending in the economy, which causes contraction and often recession. Then, to complete the cycle and stimulate the economy again, the central bank will begin lowering the interest rates once more. And so this is the market cycle. But where are we right now? And what opportunities could this mean for us? So inflation is getting under control, but interest rates have been high for quite a while now. And with unemployment data now rising, it could suggest that the economy is starting to feel the effects of high rates, potentially starting a recession. Now, this could signal the Federal Reserve to begin cutting interest rates in the near future. In fact, if we look at the 3-month SOFR Treasury forward curve, which shows some market expectations of US interest rates in the future, we can see that they are expected to drop to about 4% by January 2025. So where could the opportunity be? Well, historically, as interest rates decline, the bond market prices typically increase, especially with shorter term bonds. So for example, this is the 2-year Treasury bond compared to the US interest rates back to 2001. Now, as we predicted a potential decline in interest rates in the near future, naturally, one of the biggest opportunities we believe in is buying Treasury bonds. And if we look at this technically, we can see we've been consolidating since 2023. However, now we've broken major highs and shown a high volume candle. Now, we are extremely bullish on this in the next 6 to 12 months, at this point in time. But the next bit is really important when looking at other opportunities in this environment, because there's two main scenarios going forward. Scenario 1, we enter a full recession, or scenario 2, we manage to transition relatively smoothly to the expansion phase. And understanding how to spot this ahead of time, as well as what the best opportunities will be in each scenario, could be the difference between a positive trading year and a negative one. So scenario 1, we enter a full recession. First of all, how can we predict this ahead of time? So if the central bank doesn't lower rates relatively soon, we could see the economy suffer more, with unemployment rising, less spending, causing even less jobs, and a full-on recession. So we'll be monitoring a few key economic indicators to assess this. The first one is interest rates. Here, we are just looking for a gradual decline, but more importantly than that, we're looking for the central bank to respond quickly if the economic health metrics we'll go over in a minute begin falling. The main economic health metrics we want to see are, number 1, unemployment. We want to make sure that this is at the very least stable or ideally declining. Number 2 is the ISM Services PMI. So this shows the health of the US service industry, which makes up about 77% of the entire US economy. And so what we're looking for here is a value above 50, which shows the sector is at least stable, or ideally as far above 50 as possible to show that it is growing. And then number 3 is the ISM Manufacturing PMI. So similar to the ISM Services, this shows the health of the manufacturing sector. However, this only makes up 11% of the US economy, so it's much less important than the previous two metrics. So let's just say that we can predict the recession. We know what to look for. Now we need to know how to trade it / invest it. And so during a recession, money usually flows out of the stock market. Why? Because stocks are businesses and people spend less of their money during a recession. Therefore, most businesses typically make less money. Investors like you and I anticipate this before the businesses usually feel the effects, causing the prices to drop before the recession usually starts. And this is what's known as the anticipation effect. For example, in July 2024, we saw an example of this on the S&P 500. Prices fell by about 10.22% from the peak, likely due to fears of recession, as investors began pulling money out of the stock market. Now, at the same time, we saw bond prices rise because they are seen as safer in this environment, as we can see in blue here. But other assets that can work well during recessionary times are precious metals like gold, silver, and even safe haven currencies like the US dollar, the Japanese yen, or the Swiss franc. However, determining which is likely to perform best really does depend on nuances of the situation. However, by August the 16th, 2024, we've seen the S&P rebound up, likely due to stronger than expected economic indicators, such as the ISM Services PMI and inflation data we've spoken about earlier in the video. Therefore, the fears of recession were reduced and investors were more willing to put money back into the stock market. Now, if this type of behavior continues, we could avoid a recession altogether and actually be facing scenario 2. Well, first of all, how do we predict it? Well, if the central bank lowers rates over time and economic indicators show stability or even growth, then we could transition relatively smoothly. And if this happens, the US stock market will likely continue to trend for, we are predicting at least, the next 6 to 12 months, which presents some fantastic opportunities and often ones that are a lot easier than opportunities during the contraction phase. Other sectors that typically perform well during these periods are real estate, a lot of commodities, and some emerging markets. Now, a special bonus top pick that we are looking at and very excited about for the next 12 months or so is the Japanese stock market. If you would like a full breakdown on why this is, then please do let me know down in the comment section below. This is an extremely brief overview, especially of how to apply this and find the different opportunities within. But hopefully you've learned something. But for now, check out the links in the description if you would like to get in contact with me. Stay safe and thank you for watching. Take care.